America isn't just moving anymore, it's quietly escaping. Across 15 states, families are packing up not because they hate where they live, but because the math no longer works. Rent is rising, insurance is biting, taxes feel heavier, wages are not stretching far enough. Energy, groceries, and housing are all pulling from the same paycheck. In this video, we'll use real migration data, price trends, housing pressure, and plain household math to show which states are losing residents because life has simply become too expensive. 15th is Vermont, and it proves that a state does not need giant cities to become financially stressful. On paper, Vermont can look calm. It is small, scenic, slower, and far from the national argument about megacity prices. But the Census Bureau's latest state estimates show Vermont lost a net 726 residents to other states from July 1st, 2024 through June 30th, 2025. A few hundred people leaving can be a warning sign when the state is already aging, short on workers, and struggling to build enough homes. The controversial part is that Vermont is often sold as a peaceful escape from expensive urban life. Yet many residents find that peace comes with a bill. Older housing means repairs. Rural distance means long drives. Heating can be punishing in winter. Limited housing supply turns ordinary rentals into hard-to-find rentals. The Federal Price Index does not rank Vermont among the most expensive overall states, but that is exactly why people miss the squeeze. If there are only a few apartments near a job, the average does not comfort the worker who cannot find one. If the house is cheaper than Boston but needs a roof, insulation, and a heating system, the sticker price is not the real price. Vermont's story is quiet because it is not a mass stampede. It is a slow leak. Young workers leave for wages. Retirees reconsider fixed income living. Families ask whether charm is enough when childcare, housing, energy, and taxes leave little room for error. 14th is Rhode Island, a small state with a big state housing problem. The Census Bureau estimates Rhode Island lost a net 1,551 residents to other states in that same one-year period. The Bureau of Economic Analysis put Rhode Island's overall price level above the national average in 2024, and its rent measure above the national average as well. That matters because Rhode Island sits in a strange middle zone. People who cannot afford Massachusetts often look south, and that demand does not magically create more homes. It pushes on Providence, Warwick, Newport, and smaller towns where supply is limited and land is not endless. A cheaper apartment can still come with an older building, higher heating needs, parking headaches, or a longer commute into the same labor market. The controversy is that expensive places often defend high costs by pointing to quality of life. That argument works only until quality of life becomes something people watch from behind a rent payment they can barely manage. Rhode Island is not collapsing. It is still attractive, but attraction is part of the problem. When a pretty, compact state cannot build enough accessible housing for locals and newcomers at the same time, the people with fewer choices become the release valve. They move to places where ordinary space costs less. 13th is New Mexico, and this one challenges the lazy version of the story. New Mexico is not usually placed beside California or New Jersey in cost of living debates. The Federal Price Index puts its overall price level below the national average. Yet the Census Bureau still estimates a net domestic loss of 2,267 residents. In parts of New Mexico, housing has become harder to reach not because the state is uniformly expensive, but because the desirable job centers and amenity towns are no longer cheap in the way people remember. Santa Fe has long carried a premium. Albuquerque has seen pressure from buyers and renters looking for more space. Smaller communities can have thin rental supply, meaning one vacancy can attract a crowd. Add utility costs, car dependence, healthcare access, insurance, and the simple fact that wages in many areas do not match the new housing math, and the bargain starts to weaken. The small detail people miss is that a state can be statistically affordable and personally unaffordable at the same time. If the jobs in your field pay less, if childcare is limited, if you must drive farther for work or medical care, the lower average rent does not solve the household budget. New Mexico also shows how remote work changed the map. A place can be discovered by higher-income outsiders faster than local wages can adjust. People quietly leave when the old promise no longer works. lower cost, open space, and a decent life. If the lower cost remains only for people arriving with outside money, locals feel squeezed in a state that outsiders still call affordable. 12th is Pennsylvania, which surprises people because much of it still looks reasonably priced compared with the coasts. The Census Bureau estimates Pennsylvania lost a net 2,936 residents to other states in the latest annual period. The Bureau of Economic Analysis puts its overall price level below the national average, so this is not a simple, high-price state story. Pennsylvania can be affordable in one county and draining in another. Philadelphia area households face the cost pressure of a major metro region. Pittsburgh can still be cheaper than many big cities, but buyers and renters there have also felt the national wave of higher home prices and higher mortgage rates. Older towns often offer cheaper houses, but cheaper can mean older systems, higher maintenance, property tax concerns, and fewer job options nearby. Mortgage, taxes, insurance, utilities, repairs, car costs, and commuting time all sit in the same household. A low home price is not a low cost of life if the roof is failing or the job market is thin. The controversial point is that affordability rankings sometimes flatter states with older housing and slower growth. A house may be cheap because demand is weak, wages are limited, or the home needs expensive work. Pennsylvania's outflow is not a dramatic rejection of the state. It is a signal that people are comparing trade-offs more aggressively. Some retirees look to lower tax or warmer states. Some young workers chase stronger wage growth elsewhere. Some families want newer housing with lower repair risk. 11th is Alaska, where expensive life does not always show up as rent in a trendy neighborhood. It shows up in distance. The Census Bureau estimates Alaska lost a net 4,525 residents to other states from July 1st, 2024 through June 30th, 2025. The Bureau of Economic Analysis shows Alaska's overall price level above the national average, and goods prices especially high. Food, building materials, vehicles, replacement parts, and household basics can cost more because geography is a tax that never gets voted on. Alaska also has a harsh version of the opportunity bargain. Wages in some fields can be strong, but the cost of staying connected to the rest of the country is high. Flights are not a luxury when family, medical care, or specialized services are thousands of miles away. Heating and energy costs matter. Maintenance matters. Weather punishes houses, cars, and schedules. The quiet exit often happens when adventure becomes administration. The controversy is that people sometimes treat Alaska's out-migration as a lifestyle choice, as if residents simply grew tired of winter. If every normal task costs more money or time, a lower-cost state can feel like a raise even before a new job starts. Alaska reminds us that expensive living is not only about crowded cities. Sometimes it is about remoteness, logistics, and the hidden premium of being far from everything. 10th is Connecticut, a state with wealth on display and pressure underneath. The Census Bureau estimates Connecticut lost a net 5,945 residents to other states. Federal price data puts Connecticut's overall price level above the national average, and its rent measure much higher than average. On top of that, Connecticut is known for heavy property tax pressure in many communities, which matters because property taxes do not only hit homeowners. They also flow into rent, local business costs, and the price of staying in a neighborhood with good schools. The state has high incomes in many areas, but high incomes can hide high stress. A household can earn what looks like a strong salary and still feel trapped by housing, taxes, childcare, transportation, and insurance. The small detail people miss is that older high-service states often have built-in costs that are hard to unwind. Roads, schools, pensions, local governments, old housing stock, and town-by-town rules all shape the bill. When residents compare Connecticut with North Carolina, Tennessee, or parts of Florida, they are often comparing not just taxes, but how much house, space, and weather they can buy with the same income. When middle-income families feel they must be rich to live normally, the migration numbers start whispering. Connecticut is not emptying out. It is still desirable. But desirability does not protect a state from losing people who decide the comfort is no longer worth the carrying cost. 9th is Hawaii, one of the clearest examples of beauty losing to arithmetic. The Census Bureau estimates Hawaii lost a net 8,876 residents to other states in the latest annual period, and the state also had an overall population decline. Federal price data ranks Hawaii near the very top for overall prices, with goods prices and rent pressure far above the national average. They see beaches. Locals see shipping costs, limited land, high rents, energy costs, grocery bills, and family members moving away. Hawaii's cost problem is not simply that paradise is expensive. It is that the economy forces many ordinary workers to serve a place they cannot comfortably afford. Tourism and outside wealth can lift prices faster than local wages. Land is limited, building is complicated, many goods must cross the ocean. Families often double up or stretch budgets in ways that do not appear in glossy travel images. The quiet leaving is especially painful because it can separate families and culture. People do not leave Hawaii lightly. Many leave because staying means delaying homeownership forever, working multiple jobs, or watching children move away for opportunity. A housing market built around scarcity, visitors, second homes, and limited supply will not automatically protect the people who keep the place functioning. Hawaii exposes the sharpest version of the American cost crisis. The place can be priceless emotionally and impossible financially. When residents move to Nevada, Texas, Oregon, Washington, or the mainland in general, they are not necessarily choosing a better home. They are choosing a budget that lets them breathe. Eighth is Colorado, where the old promise was open space, outdoor life, and a better balance. The Census Bureau estimates Colorado lost a net 12,100 residents to other states. Federal price data shows Colorado above the national average overall, but the sharper number is rents, which sit far above average. Denver, Boulder, Fort Collins, Colorado Springs, resort counties, and mountain-adjacent towns all felt different versions of the same pressure. High-income newcomers arrived, remote workers arrived, investors arrived. Outdoor lifestyle became an economic product. Then, long-time residents were told the market had spoken. The problem is that markets speak loudest for people with the most money. A teacher, nurse, service worker, firefighter, or young family can love the mountains and still lose the bidding war. The small detail people miss is that Colorado's cost is not only a Denver problem. Mountain communities can become worker hostile when the people staffing restaurants, schools, hospitals, and local services cannot live nearby. Then commuters drive farther, traffic grows, and the cost of the lifestyle rises again. The controversy is that Colorado branded itself around quality of life, but quality of life becomes fragile when ordinary people must spend too much of life paying for it. Some residents now look at Wyoming, Nebraska, Kansas, Oklahoma, or the Southeast and see a simpler equation: less glamour, more space, lower monthly pressure. Colorado is still growing in many ways and still attracts people. But net domestic loss means the attraction is no longer one way. Seventh is Maryland, where the cost squeeze hides behind access. Maryland has strong job centers, federal employment ties, respected schools, and proximity to Washington. But the Census Bureau estimates Maryland lost a net 12,127 residents to other states in the latest period. The Bureau of Economic Analysis shows Maryland's overall price level above the national average and rents far above average. Access costs money. If you want to live near the job corridors, the commuting routes, the better-rated schools, or the neighborhoods with strong services, you pay for it. If you move farther out to save, the commute can take back the savings in time, gas, tolls, wear on the car, and stress. Maryland's problem is not that it lacks opportunity. It is that opportunity is clustered in places where housing is expensive. A family can earn a solid professional salary and still feel as if one emergency will crack the budget. The small detail many people miss is that the Washington area economy creates a pricing umbrella. Even areas that are not luxury markets can become expensive because they sit within commuting reach of powerful institutions and stable jobs. That stability attracts demand. Demand raises prices. Prices push out the very workers needed to keep the region functional. The controversial point is that states often brag about being near power, but proximity to power can become a household tax. Maryland remains a strong state for many careers. But for residents who do not have federal-level pay, dual professional incomes, or family help for housing, the state can feel like a waiting room for burnout. Sixth is Louisiana, and it shows why a cheap state can still become too expensive. The Federal Price Index puts Louisiana well below the national average overall. Yet the Census Bureau estimates Louisiana lost a net 14,387 residents to other states, a larger domestic loss than many states with higher sticker prices. The reason is that low average prices do not cancel out weak wages, insurance shocks, disaster risk, infrastructure strain, and limited opportunity in some areas. In Louisiana, property insurance and auto insurance have become major household concerns, especially in storm-exposed markets. Add energy bills, car dependence, and pockets of job market weakness, and the budget can feel unstable. The small detail people miss is that affordability has two sides: what things cost and what people earn. If wages are low, even a low-cost state can feel expensive. A household leaving Louisiana may not be escaping high rent in the coastal sense. It may be escaping uncertainty. Will insurance be available? Will premiums rise? Will the next storm damage the home? Will the local job market offer enough upward movement? The controversy is that national rankings often call Louisiana affordable because housing prices are lower. But a low purchase price can be a trap if the carrying costs are unpredictable and the local economy does not give families enough cushion. Louisiana's outmigration is not just about money. It is about risk becoming a monthly bill. When risk gets priced into insurance, repairs, debt, and stress, households start comparing not just cheaper states, but more predictable states. Fifth is Massachusetts, where even good jobs can lose a fight with housing. The Census Bureau estimates Massachusetts lost a net 33,340 residents to other states. Federal price data shows Massachusetts well above the national average overall, with rents far above average. This is one of the clearest cases where opportunity and expense collide. Massachusetts has world-class education, medical institutions, technology jobs, old towns, coastal access, and strong cultural appeal. But the housing supply has not kept up with the demand created by that success. Greater Boston is the center of the pressure, but the effect spreads outward. People move farther from the core, then the farther towns become expensive too. Commuter rail towns rise. Smaller cities rise. The state's success becomes a wave that pushes through the map. The small detail people miss is that high-paying sectors can distort the whole housing ladder. A biotech salary, finance salary, or elite university household can bid more than a teacher, lab tech, young nurse, restaurant manager, or public employee. The controversial truth is that Massachusetts often sells itself as a knowledge economy, but knowledge economies still need childcare workers, bus drivers, medical assistants, grocery clerks, and young families. If those people cannot live within reach, the system becomes socially brittle. Some residents leave for New Hampshire, Maine, North Carolina, Florida, or Texas, not because those places offer the same institutions, but because they offer a workable monthly payment. It suggests the decision is not emotional first. It is mathematical. Fourth is New Jersey, where the cost of staying can feel like a second mortgage even after you have a mortgage. The Census Bureau estimates New Jersey lost a net 37,428 residents to other states. Commuting costs and expensive services, and you get a state where the household budget can feel crowded from every direction. Access to New York City and Philadelphia, strong schools, dense job markets, beaches, diverse communities, good food, major transportation links. But every advantage has been capitalized into price. You are not only paying for your house, you are paying for access, school districts, proximity, and a competitive labor market. A homeowner can pay off a mortgage and still face a large annual bill that never disappears. For retirees, that can be decisive. For young families, it can block the next step. For renters, it is built into the landlord's costs. The controversy is that New Jersey is often mocked as a place people leave for Florida, but the joke hides a real policy problem. If a state requires very high household income just to feel stable, then middle-class identity becomes more memory than reality. Many people leaving New Jersey are not giving up on ambition. They are trying to keep ambition from becoming permanent stress. Third is Illinois, And its story is less about overall prices than the feeling that residents are paying more without getting enough financial relief. The Census Bureau estimates Illinois lost a net 40,017 residents to other states, placing it among the largest domestic outflow states by raw numbers. The pressure comes from a mix of taxes, housing burdens in certain areas, public finance concerns, winter utility bills, insurance, commuting, and the long-running perception that better bargains exist elsewhere. Property taxes are a major part of the conversation. In many communities, they shape the true cost of homeownership and feed into rents. But many households look at the full package and wonder why the bill feels so heavy when other states offer lower taxes or newer housing for the money. The small detail people miss is that outmigration can become self-reinforcing. When residents believe a state is losing people, they begin to question long-term value. Will taxes rise? Will home values keep up? Will employers expand? Will their children stay? That doubt can be as powerful as a price increase. The controversial point is that Illinois is not expensive in the same way California is expensive. It is expensive in confidence. People may tolerate high costs when they believe the future payoff is obvious. They resist when the payoff feels uncertain. People are not only fleeing cold weather. They are fleeing the idea that the household math will keep getting harder while the state asks them to be patient. Second is New York, the state that proves a place can be magnetic and exhausting at the same time. The Census Bureau estimates New York lost a net 137,586 residents to other states in the latest annual period. Federal price data puts New York well above the national average overall, with rents and goods prices also high. But domestic migration asks a different question. Among people already in the country, are more moving in or moving out? For New York, the answer is a very large net outflow. Housing is brutal in the New York City region. Upstate can be cheaper, but taxes, old housing, heating costs, and limited job growth in some areas complicate the bargain. In the city, even high earners can feel squeezed by rent, childcare, commuting, local taxes, and the cost of every small convenience. The small detail people miss is that New York prices time as much as space. A cheaper apartment may mean a longer commute. A better school district may mean a massive housing premium. A car-free life can save money, but only if rent does not swallow the savings first. The controversial truth is that New York sells ambition, and ambition has been used to justify almost any price. For decades, people accepted the trade because the career upside was unmatched. But remote work, high housing costs, and rising options elsewhere weakened that bargain. If a person can keep a good job or find a decent one in another state while cutting housing costs, New York has to compete in a way it did not before. First is California, the giant that still shapes America's dreams while losing more residents to other states than any other state in the latest census estimates. California lost a net 229,077 residents to other states from July 1st, 2024 through June 30th, 2025. The Bureau of Economic Analysis ranked California as the highest overall price state in 2024, with its housing rent measure far above the national average. The state has unmatched advantages: technology, entertainment, agriculture, ports, universities, weather, culture, mountains, beaches, and global influence. But those advantages created a price system that treats space like a luxury good. The housing shortage is the center. When homes are scarce where jobs are strong, every other cost becomes heavier. Long commutes become normal. Families delay children. Young adults live with roommates longer. Middle-income workers leave the coast or leave the state. Retirees cash out. Small businesses struggle to pay wages high enough for workers to live nearby. It is the stacking of costs. Housing, utilities, insurance in fire risk areas, transportation, childcare, and taxes can combine into a monthly wall. The controversy is that California's leaders often point to innovation and climate leadership, while critics point to regulation and taxes. Both sides can miss the human center. If a nurse, teacher, engineer, cook, police officer, or young parent cannot see a stable path to a normal home, the state's greatness becomes something they admire from another state. But net domestic outmigration shows that many Americans are separating admiration from residence. They may love California. They just cannot make the math love them back. The biggest takeaway is that Americans are not leaving only the obvious places, and they are not leaving for one simple reason. Some are escaping extreme housing prices. Some are escaping taxes. Some are escaping insurance risk. Some are escaping old homes, weak wages, long commutes, or the feeling that every raise disappears before it reaches the bank. The census numbers show movement, but the deeper story is pressure. California and New York show what happens when opportunity gets too expensive. New Jersey, Massachusetts, Connecticut, Maryland, Rhode Island, Hawaii, and Colorado show how desirable places can price out the people who make them work. Illinois, Pennsylvania, Vermont, Alaska, New Mexico, and Louisiana show that even states that do not look wildly expensive on national averages can become too costly when wages, risk, taxes, repairs, distance, or insurance enter the picture. The new advice is harder. Move where the full life works. Look at housing, taxes, insurance, wages, commuting, utilities, schools, healthcare, and family support together, not separately. A cheap home is not cheap if everything around it drains you. A high salary is not high if the state takes the raise before you feel it. And a beautiful place is not livable if ordinary people cannot stay. If this helped you see the map differently, like this video, share it with someone thinking about moving, and comment with the state you think is becoming too expensive the fastest, and whether you would stay, leave, or come back.